What's up, guys? Mike here. In my last video, I taught you guys all the basic steps that you would need to know before you buy any options. That was just the basic steps. It was a pretty long video, but I really am serious. You have to know the basics before you actually purchase any options. So if you want to check that video out, a link will pop up. Make sure to click on that before you watch this video, and then come back to this video because we're going to break down every step that you need to take before you buy a call option, what to expect, the risks that you need to be aware of, and the rewards that you will be making. Because with call options, you can make stacks of cash at a very quick pace, but at the same time, you could lose stacks of cash as well. So it has a lot of risks and it has also a lot of rewards. So the risk and rewards, you have to consider that before you take that under consideration. So with that said, make sure to smash that like button and let's begin. All right, so let's go over call options. This is a high risk strategy and it's an excellent way to make large stashes of cash if you do it correctly. But before we get started, I want to make a quick disclaimer that call options are extremely risky. You can either multiply your investments 100-folds or lose it all. And when I say all, I literally mean 100% of your premium. So don't play with call options if you don't know what you're doing, and you have to be willing to lose your full entire investment because that's how risky call options can be. All right, so let's start from the top. Let's say it's October right now and the stock that we are going to trade to buy a call option on is $21 right now. But you think the company is about to make a huge announcement and the stock price will go up $25 or above. And you might say, why don't we just buy some shares instead at $21 and sell it when it reaches $25 instead? You're going to make $4 on every share that you buy, which is a 19% increase in price. Why not just buy the shares instead? So let me tell you why. When you purchase a call option, you're buying a contract that allows you to purchase the shares at a certain price, which is called a strike price, at or before a date that you select on the option that's going to end, which is called an expiration date. But before that opportunity, you have to pay something called a premium to the person who's selling you that contract. And one contract is 100 shares. So you're not just buying 10, 20 shares. You're just buying one simple contract that includes in it 100 shares. All right, so let's say the stock is at $21 and you buy a call option with a strike price of $25 that expires in November 23. And if you watched my previous video, I explained why you should do long dated options to protect yourself from theta. Make sure to watch that video before you watch this because it makes a lot more sense when you know about that. Anyways, remember what you're doing here is purchasing 100 shares per contract at the price of $25 at any time at or before the expiration date, which is November 23rd, if the stock goes at $25 or more. So you're going to get it for 25 bucks instead of 26, 27 or more. All right. So in order to do this, you have to buy 100 shares at $25 at any time before November 23, and you pay something called a premium to the person who is selling you the contract. If you want to learn more about selling call options, check my previous video. A link will pop up. You can click on that and it will teach you everything you need to know about selling a call option to someone. Right now, what we're doing is we're buying a call option. So remember, when you sell a call contract, you're obligating yourself to sell your shares at the strike price, which right now we're selecting $25 at or before that expiration date. So what you're doing is you're taking an obligation that you expect someone to pay you for it, right? You're taking risks, so you expect to be paid for that risk that you're taking. So the people buying the call must pay you a premium, which I like to call free money. When you're selling a call option, that's free money. All right, so in this case, let's say the premium for this contract is $100. All right, so let's go over why you would buy a call option instead of purchasing the shares itself. All right, so in our example, I said one share equals $21. And for 100 shares, that's $2,100. Or what you can do is you buy just one contract, one call option that is 100 shares, and the premium here, let's say, is $100. So that means 100 shares only costed you $100. That means you have $2,000 lying around on so that you can go and play with to do something else. Right? You only have to pay $100 to control 100 shares, where someone else, if you were to buy the stock itself, you would have to pay $2,100 in order to control 100 shares, where here you only pay $100 to control the same exact 100 shares. You're pretty much leveraging your money to amplify your gains. All right, so you have $2,000 lying around. Now let's say you want to put that full $2,100 on this bet. And what you can do, instead of buying one contract for $100, you go ahead and you buy 21 contracts for $2,100. Now that 21 contracts is 2,100 shares. Okay, you just leveraged the heck out of your money, because this guy was only some guy who only buys a stock can only buy 100 shares with $2,100, where you can now buy 21 contracts. That's 2,100 shares of the same stock this guy is buying. All right, so you're amplifying your gains when the stock price increases 21 times more than someone who would just spend $2,100 for only 100 shares. So this is the main reason why someone would go ahead and buy a call option instead of the actual shares itself. All right, so let's just keep it simple. Like they say, keep it simple, stupid. So let's make it very easy. Let's say you only buy one contract for $100 premium instead of the 21 contracts that I was saying. And what's going to happen is you're going to have to wait for the stock price to rise to our selected target price. All right. And now this is the hardest point in buying options, which is the waiting period. Okay, because while you wait, your contract may become less and less valuable, and Theta is crushing the price. It's going down because time decay is happening. Like I said before, Theta Crushed, IV Crushed right now, because time is going by. You had a whole month to start in October, and as time is going by in November, your contract is becoming worth less and less if the stock does not move to the price that we selected for our option, our contract, and it's going to become less and less valuable. If the stock doesn't go above $25, the contract will lose value. So there won't be a point for you to buy the stock at $25 if it doesn't hit this price, right? Instead, what you're going to do is you're going to leave this contract and you're going to leave empty-handed, and you're going to lose your entire $100 premium because it's going to be worth less as time goes by and as the stock goes down in value. Or what you can do is, if you can't stomach it, you can't watch it go down in value, you can sell it to someone else. You can always sell the call option that you purchased to someone else as long as there is open interest. That's why I say make sure you buy an option with a lot of open interest, okay? And I want everyone to know this is the part that hurts really, really bad, because you can leave empty-handed with no stocks, with no contracts as the contract expires, okay? So I want you to know the risks here, because your option can go down in value as it goes down the stock price and as time decays, all right? All right, so back to our contract. So let's say you waited patiently for the stock to hit $25, right? And in fact, it hits $31 instead. Your contract is now good to purchase it at $25. That's $6 less than the current price. Right now it's $31, and you agreed to buy this contract at $25. Remember, all you paid for this was a premium of $100, okay? And now for this call option, when the stock was at $21, right? All right, let's review what happened. You paid $100 for this contract, and it represents 100 shares, and all we did was pay $1 premium per share for this option. Now, 1 month later, the stock is trading at $31. That's $6 higher than the strike price you agreed to pay for. Now, this stock is $31. So now your premium is $6 per share. In other words, from $100, it's now worth $600. That's what the premium is worth right now, is $600. You just made $500 profit from this one contract, and the stock is trading $6 higher than you have, and you have the opportunity to buy it at $25 and sell it at $31. So it makes sense. It's worth $600 right now, okay? You multiplied your investment by 6 folds, right? So you're getting returns like this, and buying the stock, like getting returns like this and buying a stock will take forever, okay? Like you have to have a lot of money on hand. You had to have $2,100 to buy 100 shares, but instead you only paid $100, and now you multiply your 100 to 600. You did a 6 times multiplier, right? And that usually takes forever when you buy stocks, right? Buying 10, 20 shares takes forever. By using options, you can do it very quickly, multiply your shares, your gains very quickly. Sometimes within a few hours, you could have made that $600, right? But here's a caution, a warning to you all out there. No joke. Sometimes seeing a return like this will make you say, if I can do that with just one contract, why don't I just go with 100 contracts, right? And instead, I can pay $10,000 and I would have made $60,000, right? You're absolutely right. In this case, it would have worked out for you had you gone ahead, paid $10,000 for 100 contracts, and you would have flipped it and made $60,000. All right. And I'm not saying this doesn't work. A lot of people have actually doubled or even tripled or quadrupled their money using the call option strategy. So yes, this can be done 100%, but be caution because it doesn't always work this way. And let me show you an example how this can actually destroy you instead. Let me show you how badly this can actually end for you, okay? So let's say you bought 100 contracts for the $25 strike price for $10,000, right? You paid $100 premium per contract. You bought 100 contracts. That's $10,000. Do you think your contract will still be worth $100 per contract when the stock goes down in value? Do you think that's going to be happen in a matter of couple of days later? No, this contract will be worth a lot less. All right, from that $100, it's now worth $20. Okay, that's an 80% loss in a couple of days because the stock went down. You thought you were smart and you bought 100 contracts for $10K, and now that $10K is only worth $2,000. You lost $8,000 in a matter of days. Do you think you'll have the stomach for that, to hold on it for this long when you see yourself losing 80% of your money within a few days? Let me be honest with you. Not everyone has the stomach for that. And a lot of times people suffer massive losses when it comes to call options, all right? People have lost a ton of money in a matter of days. Let's go over an example. Mr. Johnny Cash, all right? He lost $10,000 in an option in one day, And after the market closed, some bad news came out about the company, and he lost another $23,000. And guess what? He couldn't do anything about it because it was after hours, because the market was closed. And you are only able to buy and sell option contracts during market hours only. You can't do anything in pre or post market hours. So when this news came, Johnny Cash was destroyed $33,000 in a matter of a day. He was crushed, all right? He lost a ton of money. So just remember, you can suffer the same fate as this guy, as Johnny Cash, if you are not careful. Make sure you're taking calculated risks when you purchase your options, because if you do it correctly, you can make a ton of tendies and massive amounts of gains, all right? A lot of money. So don't be afraid to enhance your opportunity, but don't at the same time YOLO all of your money into an option, because you will lose everything, all right? I am serious. I'm dead serious about that. You will lose everything, all right? So don't go YOLOing your money into one contract thinking you're so smart, you're going to make a ton of money doing that, because you lose everything, all right? But if you do well and you purchase call options wisely and not take unnecessary risks, you can make a ton of money extremely quickly, even within a few hours. So best of luck to those who are willing to take those chances. I'll see you in my next video, where I will teach you how to buy or trade put options, which pretty much means you can make money shorting a stock instead of buying call options. So it's the exact opposite of buying call options. You buy put options instead. Thanks again for watching my videos. As always, make sure to smash that like button, hit that subscribe button, hit that notification bell so YouTube could alert you when my next video comes out. Also, feel free to add me on Instagram. I pretty much post there daily, so if you want to be part of that, make sure to add me there as well. Also, I do a trade of the day on Instagram, so if you want to be part of that, make sure to add me on Instagram for that as well. Also, feel free to leave a comment below and let me know what options you're considering, and I'll give you a feedback on that. Also, let me know if you had any mistakes and options that you had in the past, because I had plenty of mistakes and options myself, so I'm sure you guys have had some too. And let me know in the description below and leave a comment in there. Also, if you want 2 free stocks from the stock market, WeBull is giving 2 free stocks. One for just signing up to use their platform, and a second stock worth up to $1,400 for making a deposit of $100 or more. Also, right now, WeBull has a promotion going on where you just do 4 simple steps and they'll give you a stock of Google. You have a chance of entering the raffle to get a free Google stock that's also worth another $1,400. So you have 2 chances of getting 2 stocks worth up to $1,400 each from WeBull. This link in the description below for that. Also, Robinhood gives out a free stock. Link in the description below for that as well. Thanks again for watching my video, and until next time, make money with Mike.